Well, those interest rates, as Jerry pointed out, are beginning to rise, and for a lot of Americans, it affects more than homes or refinancings. It can also benefit, if you're a more conservative investor, you just want to put your money in a bank somewhere and all of a sudden see CD rates moving up. Let's get to read and the pros and cons of all of this with Scott Martin, Jared Levy. Jared, what do you think? Which wins out? Obviously, the rising rates are reflective of the improving economy. I know there are other factors here, including our debt, and we're going to have to print more Treasury notes and bonds to pay for that. But what does win out in your eyes?
It's a delicate dance here that the president and consumers have to play. The president talked about having strong dollar good for America, and yeah, strong dollar sounds good, but like you mentioned, from a credit card perspective, consumer credit outstanding is at an all-time high right now, and consumers revolving credit is higher than it was just ahead of the Great Recession. So if borrowing costs really rise, in other words, if current rates, like the federal funds rate, which affects the prime rate, if that really goes up sharply, which I don't think it's going to do in the next year, consumers could start to feel that. In my opinion, Neil, it's more about the psychological ramifications. Right. It's more about, do I believe that interest rates are high right now? Because again, a quarter point here and there really doesn't make a difference. But if I believe as a consumer or a small business owner that rates are really high, I'm going to be reluctant to borrow, to take risks. And that's where I think the danger could lie. So again, it's a PR dance, if you will. Yeah,
it is a PR dance. Now, for market bulls, they say all of this is reflective of an economy that is picking up considerable steam. We might get the details of that from the White House when it sort of outlines its own forecast for the next few years. But it might not be that robust. In other words, even the Atlanta Fed, Scott, as you know, is scaling back its projections for first quarter growth. I think for a while they were at 5.5%. It's now around 3%. Still isn't too shabby, but not 5.5%. What's going on?
I don't know what they're looking at. I was thinking that too, Neil. I mean, Atlanta Fed maybe sharpened a pencil or two and figured out they carried the one instead of subtracting it. I don't know what happened there. It was really weird. But the reality is this. At least they're starting from higher numbers than they were, some quarters ago where even 3% sounded really, really good. And I think Jared's right. The dance is on. And whether it's the waltz, I prefer the Charleston, by the way. But it is the do-si-do, if you will, between, yes, are rates too high? Is it worth borrowing for the future growth? Because that's really the key here. I think to your question, the S&P 500 companies win out here, Neil, because the earning growth is so strong. The tax plan is through now, and so you have so much tailwind, let's say, behind these great S&P 500 companies that the growth is worth borrowing at these higher rates, even though it is higher than it was the last couple of years.
What do you think of that argument, Jared?
Okay, so I agree with Scott that there's a lot of good momentum from the bullish perspective in terms of earnings, in terms of, the tax codes are really playing into S&P, i.e. big multinational companies. The bigger winners could be the local economy, the American-centric, companies, because remember, as interest rates go up and the dollar gets stronger, these big multinational companies, their earnings don't look so good. The other question we haven't really talked about is Chairman Jerome Powell. How is he going to be different, if different, from Janet Yellen, and our policies going to shift? It's a really tough read, because on one hand, Trump is like, I brought in Jerome Powell, he's going to, toe the line and keep this economy rolling, but he's a hawk by most accounts. And if he starts to ratchet down and bring rates up, that could get in the way of things. So you got another variable there that really isn't so easy to predict.
That's been an argument, too, Scott, that all of a sudden you get the lower taxes and people will see it, if they haven't seen already, in the months to come in their paychecks. Companies sharing more of that wealth now. But gosh darn it, it's all wiped out by higher interest rates and the cost of carrying folks' debt, which apparently a lot of Americans carry. What do you think of that?
It's been easy. I mean, rates at 1.5% in the 10-year note some years ago, was incredibly low. And I think even at the time, experts, quote unquote, not Jared or myself or you, were calling them to go to 1%. So it's scary to think that the Treasury note of the 10-year, say, is approaching 3%. Mortgage rates, 30-year mortgage now, Neil, is, oh my goodness, at 4.5%. Now, I'm not old enough to remember the high teens in the 70s, but guess what? Surprise, surprise. I can remember the mid-90s at interest rate levels at 5-6%. So the reality is perception, and it's the fact that interest rates do need to go up for many, many reasons besides the historical facts, other than the reason that economies are growing around the world in the U.S., as Jared pointed out. So That to me is a good thing that we should all be embracing. And the market volatility is probably just a precursor to higher rates coming along the way, which is going in concert with a higher S&P, in my opinion, because the fundamentals are so strong.
You know, finally, guys, Jared, I'll bounce this over you. That someone told me a group of stocks that will still be market leaders are technology stocks led by Amazon and what have you, because they are working on fundamentals that have nothing to do with economic cycles, everything to do with sort of like the new world and all of this stuff that went right over my head, but I'm sure not over yours. But that will be a story here that will eclipse whatever happens to the 10-year note and whatever gyrations we see in Washington regarding tax cuts and, you know, interest rates. What do you think of that?
You know, this is a fantastic point. It's funny, I'm literally writing about this right now. Amazon is a great example because it's not about interest rates per se. They are taking retail, transforming retail, and unfortunately grabbing business from some existing competitors. But again, they're operating within their own cycle, changing the game, you know. And I hate to go back to the FANG stocks, but it's true, you know, the Facebooks, the Netflix. Right. I mean, they are capitalizing on social shifts in business and again, capturing income from other sources rather, you know, instead of interest rates, they're grabbing it from people who failed to innovate. And I think that's the place you probably want to look if you're trying to keep yourself insulated from gyrations caused by interest rates.
Scott?
Yeah, I would go where the cash flow is, Neil, and that's in the FANGs, that's in tech. You want to go where the revenue is. You want to go where the profits is, where those companies are ringing the register. That's in Amazon, Netflix, Google, a lot of the stuff that we own for our clients.
All right, guys, thank you very, very much. All right.